Good morning, everyone. My name is Nick Khatri. I'm one of the principals here at the Worrells Brisbane office. I have the pleasure of welcoming everyone to the first webinar series of the year for Worrells. Today's webinar will be presented by Brendan Giles and Joanne Keating, our principals in the New South Wales office, and they'll be presenting on the current ATO collection payment plan policies, formal insolvency options, more sustainable. So there's plenty of ground to cover in today's session, and we hope you find the session very informative. If you have any questions throughout the presentation, please do submit them in the Q&A section, and we'll try to answer them at the end of the webinar. We also have 3 polls for our attendees to vote on for today's presentation, and this can be used on the right-hand side of the attendees hub, so you should be able to see that pop up at that relevant time. And these polls just help us improve our webinar series and our other presentations and educations that we provide as part of our framework. Look, in terms of the questions, if we're not able to get to them within time allocated today, one of our team members will reach out to you by phone or email over the next few days. Finally, we will be emailing you a copy of the presentation together with your CPD certificate for those attending today to assist you with meeting your continuing professional development requirements. Of course, feel free to distribute that presentation to your colleagues who are unable to attend today. So without further ado, I'll hand you over to Brendan Giles and Joanne Keating to start the presentation.
Thank you, Nikhil. Let's kick off with a quick disclaimer. Just everything we're going over today is by way of general advice and comment. If you have any specific requirements with a client or someone who needs assistance, reach out to one of our principals all around Australia. We're more than happy to help you. So before we dive into what the ATO is doing, we'll have a quick look at how we got here. So pre-pandemic, before we ran into the pandemic, the ATO already had a growing debt problem. In the 4 years prior to the pandemic, ATO debt was growing at 11% per annum. The Tax Office Ombudsman had commenced an inquiry into what the ATO was doing and why that debt was growing and what the ATO could do to mitigate that growth. And then we hit the pandemic, and the ATO, as part of the support measures for small businesses and individuals, they paused their collection activity and delayed lodgement programs and various other enforcement programs, and that supercharged the debt. So we saw it grow at 17% per annum from the pandemic to now. And you can see that here clearly in the graph. That's ATO outstanding collectible debt, and it's grown rapidly since 2018-19, just spurred on by the pandemic. Of that debt, the vast majority is business debt, with $33.4 billion of small business debt, and then another $9.8 billion, which is larger private business entities. And that debt is broadly distributed. There's 500,000 odd small businesses that have outstanding tax debt to make up that $33.4 billion, but a relatively small number, so 42,127 make up a third of it. So there's a concentration of smaller number of companies with large amounts of debt, and then a long tail of small businesses with smaller amounts of debt. So we'll look at director penalty notices. So they are the key tool that the ATO is using at this stage to deal with their debt problem. So they're looking at bringing that collectible debt down from the $52.4-ish billion it is at the moment back to more sustainable levels, and that's probably around the $20 billion mark, which is historically where they've been. So quick refresher on director penalty notices. If you've been to any of our webinars or breakfast events over the last couple of years, I'm sure you've heard us talk about them. But they are a notice that the ATO can send a director that makes the director liable for a penalty that is equal to the amount of debt the tax debt the company owes. And there are 2 types of DPNs. There's the non-lockdown DPN, which, while no DPN is good, that's the better one, because it gives a director a 21-day period to take action to avoid personal liability. And the actions available to them are they can cause the company to pay the debt, they can appoint a restructuring practitioner, they can appoint a voluntary administrator, or they can put the company into liquidation. Now, the worst kind of DPN is what's known as a lockdown DPN. And that kind of DPN is issued when the company has lodged its BAS or IAS statements more than 3 months after the due date, and that's the original legislated due date, or they've lodged their SGC statements more than 28 days after the due date. And that DPN is the bad one because the personal liability immediately attaches to the director. So there's no option to take action to avoid the personal liability. So the ATO has increasingly been focused on DPNs as their primary enforcement tool over the last sort of year and a half now. They plan to issue 30,000 DPNs over the first half of 2024, and the last update we had, there were about 28,000, so they're probably going to exceed that by the time we get to 30 June this year. And the ATO has 3 key focus areas for their DPN program at the moment. The first is to encourage disengaged taxpayers to re-engage with the ATO, and the ATO considers a taxpayer disengaged if they haven't had an interaction with the ATO for 90 days. So it's people who've not been responding to the ATO's calls, not been responding to the ATO's letters about their debt. You know, they're not actively trying to deal with it, and so they're issuing those DPNs as a way to try and encourage those people to re-engage with the ATO and do something about the debt. The second is the enforcement of payment of unpaid superannuation. The ATO has a very big focus at the moment on collecting unpaid superannuation, and the ATO's view is this zero tolerance approach to unpaid super. Super is employees' money, and they think that companies should be paying that as a priority, and so they're aggressively issuing director penalty notices in relation to unpaid super. And if those notices are allowed to expire in the case of non-lockdowns, or in the case of lockdowns, they're then aggressively pursuing the directors individually for those amounts too. So it's not just issuing the DPNs, there's a lot of follow-up there. And then the third is pursuing entities with high debt levels and poor compliance. So that's high debt levels over $500,000. Poor compliance is they've got more than 3, I believe, outstanding lodgements. And again, seeing aggressive pursuit of those DPNs once they expire. Whereas the phase 1 DPNs, where they're just trying to get people to re-engage, we're not seeing a lot of action once those expire. The directors are given some more time to deal with it. We're also seeing the ATO begin to issue lockdown DPNs in relation to old debts, and in particular old superannuation debts. In a number of cases, we've seen DPNs going all the way back to 2010, 2016, and for companies that have been wound up in the meantime and deregistered, and now the ATO is going back, looking into them, and issuing DPNs for those historical amounts. Now, they can only issue lockdowns in those circumstances, so the lodgements have to have been made late back in the past. There's obviously nothing clients can do about it now, but it is something to be aware of, that there is a latent risk there that the ATO is looking at. And finally, that process seems to be an automated process because all of the ones we've seen so far have involved directors who have some kind of real property. So it looks like there's some kind of vetting process, automated process going on there to make sure that they're likely to be recoverable debts. So 4 top tips to avoid lockdown DPNs, because that's really the key thing you want to do as a director. You might not be able to pay your tax debt, but at least if you get a normal DPN, you've got some time to take steps to avoid the personal liability. And so the most important thing is lodge on time, because ATO can only issue lockdowns if you're more than 3 months late for your BAS and IS, or more than 28 days late for SGC. So if you always lodge on time, there's no risk of a lockdown DPN. Second is keep your director addresses up to date. So when the ATO issues a DPN, at the moment they post them by an ordinary snail mail to the director's registered address with ASIC. So when you do an ASIC search for a company, there'll be a registered office and a principal place of business for the company. And then under each director's name, there is an address listed, and that is the address that the ATO issues a director penalty notice to. And many directors don't keep these addresses up to date, and so they don't receive the DPN, and therefore they don't avail themselves of 21 days to do something. We're seeing many cases of this at the moment where people are coming to us and they've already got expired DPNs because they never received them. And that is a statutory requirement for the ATO to send the notices there, so there's no real way to get out of it once it's expired. Third is to not dawdle if you do receive a DPN. It's not very... Look, it really limits our options if you come to us to talk about what to do on the day a DPN is going to expire. At that point, it's pretty much stick the company in liquidation. There's nothing we can do to sort of do a restructure or a voluntary administration, because those processes take a bit of time to get organised. Given the way Australia Post is, we're seeing people receive DPNs often, 4 or 5 days after they're actually dated, so they don't get the full 21-day period. Often they've only got 14 to 17 days left of that period by the time they get the notice, and so you need to be pretty quick in getting in contact with a professional, like someone at Worrells, and getting advice, and then looking at your options, and then preparing for what you're going to do. Because if you do want to take a small business restructuring route or a voluntary administration to deed route, there is often some pre-work to prepare for that, and that can take a week or two, and so we need that time to go through the process. And the last is to actively deal with the ATO and your tax debts. So if you are, at the moment at least, if you are engaging with the ATO, you're talking to them, you're discussing with them about payment plans and options to deal with your tax debt, letting them know what's going on, they are generally not issuing direct penalty notices to directors who are doing that. It's more the directors who stick their head in the sands and don't respond to ATO correspondence, don't talk to the ATO that are getting them. And so at least as a short-term measure, if actively corresponding with the ATO and engaging with them about the tax debt, it's going to protect you from a direct penalty notice on some level. Next, take a look at ATO payment plans. So the ATOs traditionally allow businesses to enter into a payment plan to settle a tax debt with payments over time. There are some downsides for payment plans. And the first is that any credits or refunds received while you're in a payment plan are withheld by the ATO to reduce the outstanding tax debt. And that can cause significant problems for businesses that rely on those refunds as part of their cash flow, especially things like primary producers who aren't collecting GST on their products, they're just getting refunds on their inputs. The ATO will also continue to charge interest on the debt at a very high rate. At the moment, it's 11.38%. You can get business finance for significantly less than that. So ATO debt has become quite expensive finance at the moment, if that's what you're using it for. And the company still has to lodge and pay all of its current activity statements on time while it's on the payment plan. So you're essentially double paying your tax while you're on the payment plan, because you're making the payment plan payments, and then you've got to make your monthly or quarterly payments as well, and that can lead to significant cash flow issues for businesses. Another quick warning is payment plans do not remit a director penalty notice. So up till about 2020, one of the options when you received a DPN to remit that penalty was to cause the company to enter into a payment plan. There was a court case in 2020 the ATO was involved in where the court ruled that when a company enters into a payment plan, the full debt remains due and payable despite the fact they've entered into the payment plan, so it doesn't remit the debt. And so it doesn't remit a DPN. And so if you enter into a payment plan in response to a DPN, the directors remain exposed. And we've seen a couple of cases where directors have been somewhat tricked by the way the ATO deals with this. So if a director receives a DPN and then enters into a payment plan on the 21st day, the ATO won't transfer the penalty onto the director's individual tax account. So if you get a DPN and it expires, you'll see on your client's individual account in MyGov, there's a penalty notice line that pops up with the amount. They don't do that while the company's in the payment plan, but as soon as the company defaults, they will then add it to the individual director's personal account. And so we've seen a couple of directors get tricked because they've entered into a payment plan, the debt hasn't transferred, they thought, okay, we're all good. And then it turns out that's not the case. So looking at the ATO's changing approach. So during COVID, one of the things they did as part of the support measures was really be very permissive with payment plans. They'd allow companies to enter into what I would consider non-commercial payment plans. We had a particular case where a client entered into a payment plan where the monthly payments were less than the monthly interest that was accruing on the debt, which made no commercial sense, but they managed to get a payment plan for that. But that process has now changed. The ATO are cracking down on payment plans, and they're going back to more of the pre-COVID strategy, where it's a much more difficult to get a payment plan. Now, part of putting this presentation together, we did a survey of some of the accountants in our network, And 64% of the accountants that we surveyed said the ATO had become less receptive to payment plans in the last 12 months. 78% were finding that the ATO is demanding more information to support payment plans than they were last year, and 81% said that the ATO is now demanding the full balance of a debt be paid if a payment plan is defaulted on. And that certainly dovetails with what we're seeing. At the moment, you generally get one go at a payment plan. If you default, that's it. You won't get another one. And the ATO are looking for significantly more information to support payment plans when they entered into. So entering into a payment plan for debts under $200,000 remains relatively easy. As long as you've got all your lodgements up to date, you can go into the ATO portal for a particular business. There is an option under accounts and payments to make a payment plan, and you can go through a streamlined sort of questionnaire to complete a payment plan. There are some limitations. The payment plans have to be less than 24 months, and you have to make at least a 10% upfront lump sum payment. And the software automatically factors in the general interest charge as part of that payment plan. It calculates out your payments, and it can get approved automatically through that system. It does not always work for every business. There's obviously some flags in the back end of that system that flags certain businesses, and even though they meet the requirements, it doesn't work. We're not sure why that is, but it is a streamlined process with smaller businesses with lower levels of debt. For debts over $200,000, it's a more complex process, and it is a manual process. You need to call the ATO and approach them and ask for a payment plan. And at the moment, for the majority of payment plans, the ATO are asking for significant evidence. So they're looking for 3 years of financial statements and 12 or 18 months of cash flow forecasts to show that the business can meet the payment plan. And we're also seeing sort of 18 months to 24 months as the limit of time that the ATO will let people go out. We're not seeing 3 and 5 year payment plans anymore like we were seeing during COVID. The other thing that we've started to see is the ATO is asking for security, especially for larger debts, as a condition of entering into a payment plan. So they're asking for security over the company's assets and also security over directors' assets. So things like real property, they want mortgages over homes, they want all PAPs over the company. And so that's an additional factor that's being added in. The ATO are also taking quite a long time at the moment to deal with payment plan requests. As part of that survey, we asked accountants how long it was taking to get payment plans approved, and only 27% of payment plans were being approved in less than 6 months, and 31% were taking more than a year to get done. So it can take a significant amount of time now, especially for larger, more complex entities, to get a payment plan approved. And in the meantime, the business is sitting in limbo without a payment plan, general interest charges continuing to accrue. Waivers of interest and penalties are still available. So there is a special program for eligible small businesses with annual turnover less than $2 million and who have an ATO debt of less than $50,000 that has been overdue for less than 12 months. If you meet those criteria, you can apply for an interest-free payment plan with the ATO. There is a wrinkle in that you need to show that you are unable to obtain ordinary commercial finance to pay that debt. And so usually you get a loan application, you make a loan application through a finance broker, you get rejected, and that'll tick that box. Interest and penalty waivers, however, are becoming more difficult. Again, from our survey, only 40% of payment plans at the moment are including a penalty waiver, and only 31% include an interest waiver. So it's fallen significantly from during the pandemic numbers, where we're up around 70–80%. And we're also seeing the ATO defer the waiver of penalties and interest to the end of the payment plan. So you enter into a payment plan for, say, 18 months, and if you get to the end, we'll then waive the interest and penalties. And that means at any point, if the business defaults, the penalties and interest are still payable on that debt. A quick look at an insolvency alternative, which is small business restructuring. And for small companies with smaller ATO debts, this can be an option to get them into a better payment plan in a shorter period of time. So small business restructuring it's a formal insolvency process that was introduced in 2021 as a response to COVID and to give small businesses an option to deal with the accrued debt that they built up during COVID. The government was aware that was a problem, and this was their policy response. And what we've seen from the ATO is they have a very positive opinion of this process. They want to see small businesses doing it and using it to deal with those accrued debts from the COVID period. A quick case study, this was an electrical contractor in Western Sydney. They had ATO debts of approximately $350,000. And they proposed a restructuring plan through the small business restructuring process to pay 31 cents in the dollar to creditors. And this was a plan that the ATO accepted. And just comparing it between what a payment plan versus a restructuring plan would have been. So under a payment plan, they would have had to pay 10% upfront, which would have been $35,000 in this case. Under a restructuring plan, they need to pay our remuneration upfront, and in that case, it was $15,000. The monthly payments under a payment plan would have been $14,800 for 2 years, and that incorporating the general interest charge. Under the restructuring plan, they're paying only $9,500 for 12 months. So total outlay under the restructuring plan is $114,000 rather than $389,950. So we get over $250,000 saving by entering to small business restructuring. And in this case, that allowed the business to remain viable and continue trading. If they would have only had the option of a normal ATO payment plan, they would have had to wind up the business. It wasn't viable for them. Just a quick look at the pros of both options, because they do both suit different applications. So small business restructuring, one of the big benefits is there's a statutory time period. It's 35 to 45 business days, and you get a response. You know yes or no from the ATO. There's no waiting around for 12 months like 31% of payment plan applications currently are. So the business can get certainty about what's going to happen. You can include other creditors in the compromise. I know in New South Wales, we're seeing a lot of action from Revenue New South Wales at the moment pursuing businesses. And so you can roll that debt in as well. And also if you've got any difficulties with suppliers or business finance that you can't repay. You can compromise your core ATO debt, which is something you cannot do through a payment plan. The ATO will in certain circumstances compromise interest and penalties, as we talked about before, but they won't compromise core debt through a payment plan, but they will through a restructuring plan. There's generally a smaller upfront payment with the restructuring plan, but that depends on the quantum of the debt. And there's no interest payable. Once we enter into a restructuring plan, it's a fixed amount and the interest doesn't continue to accrue. That all looks pretty good, but there are circumstances where payment plans do make sense. It's a simpler application process for a payment plan generally. While you do need to give the ATO more information now than you used to in the past, an SBR is a formal insolvency appointment, and there's a lot of information you need to give to support the restructuring practitioners to do their job. You don't need external assistance to do a payment plan. Businesses can just make an application themselves. It's probably better if they get an advisor to assist them, but they can if they want to do it themselves. Now, one of the key things with a payment plan is you don't have to make a declaration of insolvency. So when you enter into a restructuring, directors need to make a declaration that the company is insolvent or likely to become insolvent. It's one of the requirements. And there are certain businesses where making that declaration will breach covenants, cause contracts to terminate, and that will destroy the business. It's a declaration they cannot make and have their business survive. And so that makes restructuring or other formal insolvency processes not an option for them. And that means payment plans are a good option there. There's also no impact on trading or public notice required with a payment plan. So again, when you enter into restructuring, there's public notice that you've entered into it that can affect supplier accounts. It can affect your access to credit while you're going through the process, which may have a significant impact on the business, depending on the business. Something to consider. And finally, payment plans are available for debts over $1 million. Small business restructuring is limited to companies with less than $1 million of debt. There is a process, voluntary administration, that Joanne will talk about a bit later for companies that have over $1 million of debt. That can be a much more complicated and expensive process. Lastly, quick look at wind-up notices, which is the ATO's sort of final last-ditch tool that they can use for a company that isn't paying its debts and isn't addressing those debts. And that is, they go to the court, and the court appoints a liquidator who takes control of the company, sells its assets, investigates what happened, and then distributes any surplus money to creditors. And generally, the ATO prefers not to wind up companies if they can, but they do get forced into it eventually if businesses won't take action to deal with their debts. Looking at wind-up notices, you can see pre-COVID, there's sort of a steady process there by the ATO where they're winding up businesses. We hit COVID and they stopped all action pretty much altogether. And then they have restarted again since COVID, but they're not quite up to pre-COVID levels yet. And given the number of companies that have outstanding debts and the slow response rate to ATO's debt recovery actions, I think that ATO wind-up action is just going to go, that graph's going to go up and to the right. It's going to be significantly more of it as the ATO works to bring that $50 billion debt down to something more reasonable. It is important, if you've got a company that has unsustainable ATO debt, that you take steps to do something yourself before the ATO commences wind-up action, because once wind-up action has started, the court is involved and other options become more difficult. It's not that they're unavailable, it's just they become more difficult. So if you want to voluntarily put your company into liquidation, you cannot do that once the ATO has commenced wind-up action. It's a strict thing that you can no longer do. There are options to get a company into liquidation through another process like voluntary administration, but it becomes more expensive and more difficult. And similarly, if you want to do a small business restructuring, while an SBR will pause a wind-up application, there's a discretionary power of the court. And so we need to show the court that allowing the restructuring to continue is in the best interest of creditors. And so that adds costs because the restructuring practitioner is going to have to provide some evidence to court. They're going to have to retain a legal practitioner to represent them to allow the restructuring to continue. And so that additional cost is something that's going to be borne because you acted after the ATO had commenced wind-up action. And additionally, with restructuring, the ATO prefers to see businesses being proactive about their tax affairs and moving to deal with it through something like a restructuring process before the ATO forces their hand by filing a wind-up application. So if you take action early before the ATO forces the business to, they're going to get a better hearing from the ATO. They're more likely to have a plan accepted. A quick comment on ATO's focus on employee entitlements. The ATO have a key area of focus in 2024, which is on employee entitlements, and they're doing that by way of random employee tax audits through 2024. We've seen a couple of these. They are quite exhaustive, and their particular focus is on confirming that employees have been paid the right amounts, that the right amount of PAYG has been remitted, and that the right amount of superannuation has been paid to employees. So just something to be aware of. I talked a bit before when we were talking about DPNs. The ATO are issuing DPNs in relation to historical super, and that's part of their current focus on superannuation and the recovery of superannuation. We've seen them issue them. In one case, they issued a DPN for amounts from 2010 to 2016. That company was wound up in 2018. It was deregistered in 2020, and they've issued a DPN all the way in 2024 for those amounts, way back 20 years ago. And so this is a latent risk that you just need to be aware of with your clients. There's nothing anyone can do about it at this point. If the company's deregistered and you didn't pay your super and lodge your super on time back 5 years ago, there's no steps now that can really be taken. It's just something to be aware of, a latent risk that may have to be dealt with. And the important thing with this is just make sure that going forward, all the lodgements are on time, because that mitigates this risk in the future. Credit default reporting. So for the last couple of years, the ATO has had the power to report companies that have more than $100,000 worth of debt that is more than 90 days overdue to credit reporting agencies. They made very sparse use of this power through 2023 until December, when all of a sudden they reported about 27,000 businesses for ATO tax defaults, and they seem to be continuing to make steady reports. So I think the ATO has obviously got a system in place now to process those defaults and make sure that they are reported. In my opinion, this process is a bit self-defeating because it's very hard for a company to obtain finance as soon as it's got a tax debt default on its credit record. And that makes it harder for the business to access finance, to do something to try and resolve its tax debt. There are processes that you can do to get that default removed. So entering into a payment plan or entering into a restructuring plan or a deed of company arrangement is grounds to get that default removed. So if you do have potential to obtain finance and just need that default removed to get the finance to deal with the ATO debt, there are processes there you can go through to facilitate that. Engagement of debt collectors. This was announced early in January. The ATO was engaging Recoveries Corp to collect tax debts from about 150,000 taxpayers, and it's smaller debts that Recoveries Corp are working on. The ATO don't have the resources to deal with all of this debt on their own, and so they're outsourcing some of that collection activity. From what we've seen from clients of referrers that have been contacted by Recoveries Corp are trying to get people into payment plans to deal with that debt over time, but they are relatively good to deal with at the moment. Before we look at the formal insolvency options, there are some informal options to deal with tax debt. And in particular, the ATO does have a process where an individual or a company can make an application to compromise a tax debt. We've tried to do a couple of these. It is very difficult to get the ATO to deal with these. It's even difficult just to get the form that is required to submit one of these. It seems that the ATO, this process is not well understood within the ATO because it's very difficult. There are some strict criteria, so the debt has to be undisputed. The compromise or proposal has to be for not less than the taxpayer's total assets. So you're going to essentially give the ATO everything. The compromise can't directly impact other actions the ATO is taking. So if they're doing audits or things like that, it can't impact that. Hardship can't be the only reason. The return has to be better than alternative collection options available to the ATO, and that includes if they issued a director penalty notice. So if you're trying to do a compromise in a corporate entity and the ATO could do better by chasing the directors, then it won't work. And they can't have a poor compliance history. And so very high bar to get over and very difficult to deal with the ATO with these. And so often doing something like a restructuring process, voluntary administration for companies or a Part 10 agreement for individuals is a better option just because there are teams in the ATO that are used to dealing with those processes and understand them. Finally, applications to void tax debt. So in specific circumstances, and they're mainly hardship basis, the ATO will void tax debt. And so you can make an application by completing a form which shows that you're unable to pay the tax debt or that would cause significant hardship. This is only available to individuals and deceased estates. It's not available to companies, trusts, or partnerships. And often bankruptcy can be a more cost-effective option than going through this process because there is a bit of work required to make one of these applications. And if you've got limited income and no assets, you can go to AFSA and declare yourself bankrupt for free, essentially. And so that can often just be a simpler, more efficient option. Now I'll hand over to Joanne to take us through the insolvency alternatives.
Thank you, Brendan. Good morning, everyone. So Brendan has gone through and had a look at SVRs as an alternative to a payment plan. But as you appreciate, we are an insolvency firm and we were going to get here. And so we're going to talk about other insolvency options that are available for individuals and companies. So for companies, the other alternatives are voluntary administrations and voluntary liquidations. For individuals, there's Part 10 personal insolvency agreements and bankruptcy. So I'm going to just talk through each appointment and give a case study which will help get a true understanding of how the appointments work. So first up is voluntary administrations. So this is designed to assist insolvent companies to satisfy their debts by either entering into or executing a deed of company arrangement or placing the company into liquidation in a quick and inexpensive way. There is a third alternative option available for creditors, and that's to hand the control back to the director. This is very rare, and I think I've only had it a couple of times in my career where the company has actually gone back to the director. So the voluntary administration process is to maximise the chances of a company continuing to exist, given the opportunity for directors or third parties to propose a deed of company arrangement to creditors. There are two meetings or creditor meetings that are held within the voluntary administration period. The first one is within, or was convened within 8 business days. And then there is the second creditors meeting that is usually held within 25 business days after the appointment. And at that meeting, the creditors have the option to decide the future of the company, usually, as I said, between a deed of company arrangement or placing the company into liquidation. The deed of company arrangement is a formal agreement between the company creditors and other stakeholders to compromise the company's debt. It sets out the terms, conditions, warranties, and indemnities to the extent and nature of the obligations. It binds all creditors, both unsecured and secured, to the extent of the shortfall of their securities, and releases the companies from its debts, at least to the extent within the deed of company arrangement terms and conditions. So a case study on a voluntary administration. We recently did a VA of a small commercial kitchen supplier wholesale. It supplied kitchen consumables such as paper products, disposable cutlery and takeaway containers, as well as food handling equipment such as chef's uniforms and kitchen-related PPE. It was a high turnover, low margin business, however, was impacted by COVID, and because it was in hospitality, there was a significant decline in the business due to the pandemic. There was also a flood in the warehouse, which destroyed a significant amount of inventory and stock. To make matters worse, there was a high rate of bad debt because a lot of the hospitality clients, due to the pandemic as well, closed their doors, and so they had no money to pay the company. This resulted in the company having 1.2 million in unsecured debt, including unsecured loans made by the director of 150,000, unpaid rent owing to the director for $280,000, and an ATO debt of nearly 700,000. There was also a balance of trade creditors. The director obviously was anxious to avoid liquidation for personal reasons, and in the reality, there was insufficient realizations of assets available for creditors, so there was only mainly stock and pallet racking to cover costs. So the only real potential recovery if the company went into liquidation was a potential insolvent trading claim, which was estimated to be about 600,000. However, following costs, the amount would have been reduced to about 480,000 available to creditors. So I talked about the limited stock that was available. At wholesale value, that was about 350,000, but in a forced liquidation scenario, it would have been 5 cents in the dollar, so less than 20,000 would have been available to creditors. The director, as he had industry contacts, believed he could get a higher realizable value of about 150,000 for the stock. And the trade debtors that were available were very limited due to a lot being collected prior to our appointment, and the remaining balance of the debtors were bad debts. So the director proposed a deed of company arrangement to creditors, which comprised of the following: that he guaranteed a minimum recovery of 150,000 from the stock, that he would sell the warehouse that he owned personally, that the company occupied, and make a voluntary contribution under the DOCA for 300,000. And he would also not claim for the rent or his loan under the deed of company arrangement. Our fees for the VA and DOCA process were estimated to be about 60,000, leaving 390,000 available for creditors. This resulted in a return to creditors of between 0 and 40 cents in the dollar return. However, it was towards the lower end due to it being reliant on the insolvent trading claim. That was unknown at that stage. Whereas the DOCA proposed a 44 cents in the dollar return, and there was little risks as the funds were guaranteed by the director and backed by the real property that was being sold to fund the DOCA. So the DOCA was accepted and provided a better return to creditors than it would have received in a liquidation scenario. I'll now move on to liquidations. Sometimes this is necessary that the business has reached its natural end and is sometimes the best option available to directors to just wind up the affairs, and they're unable to reach an agreement to pay any of the outstanding debts. It's a formal process, and liquidators deal with the remaining assets of the company and operations, and it's the only way that a company can typically be fully wound up the affairs and end the existence of the company. So I'll go into a case study here where actually it was the obvious choice for the director to place the company into liquidation. It was again another industry that had been affected by the pandemic or COVID-19. It was an IT business in the audio and visual space, and the business had declined significantly due to the pandemic, and there was no real prospects of the company returning to profit and paying out the outstanding debts. Also, another issue with the company is that it had a lot of long-term employees with its significant employee entitlements owed to them, and the company had insufficient assets to pay out the employee entitlements if it ceased trading or when it ceased trading. So placing the company into liquidation enabled the employees to access the government guarantee scheme or Fair Entitlements Guarantee scheme, which allowed for the employees to be paid in full when the company ceased trading and was placed into liquidation. During the liquidation, as we were appointed, so the employees were paid by FEG. We recovered about 40,000 in debtors and realised another 20,000 from the remaining assets and stock of the company. Also, it was a good choice for the director because the director had made all his lodgements on time, tax lodgements on time, and therefore there was no risk of a lockdown DPN or director's penalty notice. Also, another thing we look at during a liquidation is the insolvent trading claim, and that was estimated to be around $30,000, which was not commercial for the liquidator to pursue. So therefore, in this case, liquidation was an obvious choice for the directors of the company. I'll now start to talk about individuals and the options available for individuals. The first one is Part 10, Personal Insolvency Agreements. I talked about voluntary administrations and DOCAs. This is very similar for individuals to enter into, and it's designed for the individual to facilitate their financial rehabilitation. So there's a formal agreement, a personal insolvency agreement or PIA, and this is governed under the Bankruptcy Act and is an alternative to bankruptcy. So the individual or debtor appoints a controlling trustee and they propose the PIA to their creditors. Similar to a DOCA, it outlines the debtor's financial situation, including their assets, liabilities, and the proposed plan to provide a commercial return to creditors. The controlling trustee is typically a registered trustee and they oversee the process impartially. They evaluate the individual's proposal, and then they convene a creditors meeting within 30 business days after the date of appointment, detailing their recommendation in the proposal. There's usually a comparison, very similar in a VA, between the PIA and what creditors would receive under that PIA and what they would receive under a bankruptcy. At the meeting, creditors vote by a majority vote. So it's by special resolution, being majority in both number of creditors and more than 75% in value. If the PIA implementation is successful, the individual debtor must adhere to the agreed terms of the PIA, and the funds realised under the agreement are distributed among the creditors in accordance with the terms of the agreement in full and final satisfaction of the debt. So like I said, it's similar to a VA or DOCA, and much like an SBR and DOCA, the ATO is very open to using PIAs or Part 10 agreements as a mechanism to compromise debt. So I have an interesting case study in relation to a Part 10 agreement. So the doctor ran a specialist pain management clinic. This meant that he was prescribing a lot of opioid pain medication, which triggered a Medicare audit. The audit itself did not have any adverse findings in relation to the prescription medications. However, it did find that the doctor had been running a telehealth consultation through Medicare, which we're all very used to now post-pandemic, but this was before the pandemic, so was not permissible under Medicare. Therefore, as a result, the doctor was ordered to repay several $100,000 to Medicare, which he did over the next few years. However, this repayment of this debt coincided with the pandemic and a family court proceedings with the company's with the doctor's former spouse. There was significant cash flow for the doctor now. So he was repaying his Medicare debt, paying his legal fees, paying the mortgage on the house with his first spouse or former spouse that was living in the first house or property, and paying the mortgage on the new house that he lived in with his new spouse. So given his reduction in income during the pandemic, there was an insufficient income to pay his tax debt. So as a consequence, his tax debt rose to $650,000 over a 3-year period. So post-pandemic, the doctor's income returned to normal, so about $350,000 net per year. And his family court proceedings had concluded. The old house was awarded to his ex-wife, and the new house that he jointly owned with his current wife had equity of about $80,000, of which he was entitled to 50% or $40,000. So now his only creditors were the mortgage and the ATO. We identified that the pandemic business interruptions caused a factor to his insolvency position. So he proposed a PIA on the following terms. His wife would contribute $40,000 in monthly contributions to compensate creditors for the interest in the real property that he had with his current spouse. Then the doctor would pay income contributions of $72,000 per year for 3 years, which equates to $12,000 a year, more than his projected pay in income contributions if he were to go bankrupt. The PIA offered a projected return of 31 cents in the dollar, compared to 18 cents in the dollar to the ATO. So this was accepted. We did advise the individual that bankruptcy would have been cheaper and easier for him, and he could keep the house if we sold his interest to his wife. But he wanted to avoid bankruptcy at all costs, and this PIA achieved that outcome for him. So I'll just talk a little bit about bankruptcy and then go on to a case study for bankruptcy. So again, this is a legal process for a financial fresh start for individuals. They appoint a bankruptcy, the individual appoints a bankruptcy trustee to administer their affairs and to provide a fair distribution to creditors of divisible assets. It's a way of individuals resolving their debt problems, and also it's one way for creditors to take action against someone for their unpaid debts as well. So a trustee is appointed to manage the affairs, as I said. This can be done by a private trustee, such as Worrells, or as Brendan indicated earlier, there is a free government trustee for those who can't afford a private trustee. And then the trustee can be appointed by the individual themselves or by court, by application by a creditor. So like a liquidator or the trustee has to investigate the bankruptcy affairs and recover any divisible assets that the bankrupt owns. There are a few exceptions, such as superannuation. So the trustee will realise the assets and pay any surplus funds after the payment of fees and costs to creditors. There is a threshold, and at current, bankruptcy is also liable to make income contributions to their bankrupt estate if their income exceeds a specific threshold. This threshold is based on the number of dependents the bankrupt's had, and currently it is sitting at $68,768 after tax for a bankrupt with no dependents. So half of any net income the bankrupt earns after the threshold has to be paid to their bankrupt estate. Generally, a bankruptcy lasts about 3 years. However, the term can be extended if the bankrupt does not comply with their obligations to assist the trustee, provide information as requested, and pay income contributions. So a bankruptcy case study. This is where the individual sole trader didn't want to save the business. So bankruptcy was a good option for this individual. So this was a roof contracting business that again had issues before COVID and during COVID. It operated as a sole trader, meaning all of the debt rested with the individual owner. This was not an ideal structure. However, it was an historical one that had happened, and it started out as a one-man band and grew quickly with little thought about the structuring of the business. The business had a legacy ATO debt problem to the tune of almost $2 million, and COVID just made matters worse. And by the time they sought advice from us, he owed the ATO almost $3.5 million. Like I said, the owner didn't want to continue the business and had already completed the remaining contracts, let his staff go, and essentially ceased trading. He'd also taken a lower stress job as an employee. So bankruptcy, as I said, was the obvious choice for this individual. He'd obtained a good job that paid well, but there was no real prospects of him ever paying off the debt that was owed to the ATO, as he had no significant assets, and there was also no impact for him if he declared himself bankrupt. So the only downside for him was a small amount of income contributions of around $10,000 per year that he would have to pay for the next 3 years while he was bankrupt. I'll just talk a little bit about voluntary deregistration, because we often get asked about this as an option rather than actually appointing a liquidator and winding up the affairs. This is not a real option if you're dealing with the tax debt, because the director has to declare that there are no outstanding liabilities of the company to allow the company to be deregistered, and making a false or declaration on their deregistration form can be an offence punishable for up to 5 years in prison. Also, there is strike-off action. This again does not deal with the ATO debt. This usually happens if a company does not pay their annual review fee to ASIC, and ASIC will strike off the company after around 18 months. The ATO can still issue a DPN to directors even if the company has been struck off. And the only way that the director can deal with this is to get the company reinstated to avoid personal liability. And that is done via an urgent application to court to reinstate the company, which can be costly and very expensive to do. So the future action, ATO action. These are our predictions and what we think will happen going forward. We've looked at it in comparison to, say, the GFC back in 2008, and we think the impact of COVID will have a similar effect. So during the GFC, the ATO took a very similar approach that they did during COVID, where they stopped enforcement action and allowed businesses the breathing space, and therefore allowed the debt book to grow to historical levels, which is what's happened with COVID. So during the GFC, the impact for insolvencies didn't really happen till later in 2011 to 2013, when the ATO played catch-up to bring down the debt book that had got to higher than average levels. So we predict, given that COVID and the GFC as a model, we think that insolvencies will reach levels in 2025, so next year through to 2027. So some closing tips and to keep the ATO on the good side is to lodge on time. Even if you can't pay, just ensuring that you've made your lodgements on time. Stay engaged with the ATO and seek advice early and take proactive action to deal with outstanding tax debt. The ATO prefer businesses to approach them rather than react to the ATO's recovery action. So we're open to any questions.
Thank you, Joanne. I think Francis had some questions.
Okay. We have a number of questions. I'll start with the first one. Did the ATO put out a tender for the debt recovery process?
No idea. I don't know how they decided on recovery score. I only found out about it when the ATO announced it. So.
The second question we have is a DPN the same as a default listing by the ATO?
No, so there's two separate processes. So director penalty notice is a notice that gets sent to a director that essentially transfers liability for a tax debt onto the director. Whereas a default is when the ATO lodges a credit reporting default, so with credit reporting agencies like Alares or Credit Watch. And so when someone applies for credit, it will come up to show that there's a outstanding tax debt that's in default.
And the third question is just regarding the interest charged by the ATO. Previously, you were able to get that interest remission of the interest charge. Is that still available?
So it's becoming more difficult to get a remission of the general interest charge. I think there was, from the survey results, only about 30%, I think, are seeing a remission of interest of requests, so actually seeing a remission. So they're making it a lot more difficult. And it's also generally they're deferring remission to after you've paid the debt. So if you can come to them and say, I'm going to pay the debt in full, I've got some finance, they might give you a remission. Or if I'm going to enter into a payment plan and you complete that payment plan, they might give you a remission of that interest. An important consideration, since it's come up in the question, with that general interest charges from 1 July, it also becomes is no longer tax deductible, that interest. So that interest becomes even more expensive from 1 July this year.
The next question we've got is just regarding the issuing of DPNs to directors. What happens with directors that have a street address, but you can't receive postal mail at that address?
That is a very good question. So under statute, the ATO just has to post it. And it's considered issue as soon as the ATO sends it. So it doesn't matter whether the director gets it or not. So in that case, I would expect that, unfortunately, the director's out of luck, and they're not going to receive it, and they're still going to end up liable for the penalty.
We have a question just regarding the SBR process and non-lockdown DPNs. Is it correct that once you propose an SBR, that non-lockdown DPN is no longer applicable?
Yes, that's correct. If they have appointed within the 21 days of the date of the DPN.
The next one might just be a comment and for reflection for our audience. One of our clients is seeing that small debts for individuals around 10,000. You cannot propose, I think, a payment plan online, whether anyone else is finding that there's debts out there that you're not able to propose a plan online.
I've actually had that where the amount is too small and or the payment plan is just too short, like they'll pay it in 6 weeks or something. So I know this particular individual, the accountant said, well, just leave it and just pay it, because by the time they've processed it within that 6 weeks, you'll have paid it. So I think, yeah, there are circumstances where the amount can be small and the payment arrangement's too short a period for them to accept.
And just one last question, just regarding SBRs and their impacts on potentially licenses and registration. Has there been any impacts on government bodies such as like the Queensland Building Commission if you propose an SBR?
That is a very complicated question because there's all sorts of different licenses in different states and they all have different rules. And that is something we're working on, a little guide that we're going to put out. It's probably about 6 to 8 weeks away, that runs through a lot of those, a lot of what happens for different types of appointments with different types of licenses. So just keep your eye out for that. It'll be coming from Worrells.
Well, that's all the questions we have for today. Keep an eye out on your inboxes. This afternoon, you'll receive an invite to our federal budget webinar on May 17th with CBA Commonist Harry Otley. You can also visit the Worrells website to see all our upcoming events. Thank you to Brendan and Joanne for a fantastic webinar, and hope to see you all in May.
Thank you, Francis. And thank you all for attending.